Welcome. Thank you for joining us.
Thank you, Chairman Brown, Ranking Member Corker. I'm delighted to be here today on behalf of the U.S. Chamber of Commerce, the 3 million members, each of whom are customers of banks. So we're representing the customer side this afternoon as well. My name is Tony Carfang, and I'm partner with Treasury Strategies. We are a leading consulting firm in the area of treasury and cash management. We help corporate treasurers day in and day out manage their risk, raise their capital, fund their accounts, and meet their payrolls. We also work with financial institutions, large and small, in fact, around the globe, who provide services to businesses to make productive use of their capital. I'd like to leave you with 4 messages today. Number 1 is that the U.S. economy is the most capital efficient in the world. None comes close, and I'll share with you some statistics in a second. But I want to say that this is a delicate balance, and we need to make sure as we move to the next generation of financial services, we don't destroy the capital efficiency that we've worked 2 centuries to achieve. Number 2 is that the U.S. financial system is a very delicate mosaic of banks, money market funds, securities firms, institutions large and small, serving corporations large and small, who have needs that in some cases are regional, some cases are global, some are industry specific. And what we have is actually a very beautiful mosaic of all of this coming together, and we need to understand how this all works before we begin changing it. The third point I'd like to make today is that risk is like energy in that it can neither be created nor destroyed. It can only be transferred. So please don't be lulled into thinking that if you eliminate a risk in a particular institution, that risk goes away. It goes somewhere else, and we need to understand where it goes. So for example, if a bank is unable to help a client hedge commodities, let's say, then there is a farmer out there somewhere whose crop is at risk. So we've taken the risk out of the bank and put it back on the farm. We need to be careful about that. Similarly, a manufacturer who cannot hedge foreign exchange may choose not to export and may actually shrink the size of the company. There's an interconnectedness here that we need to be very careful to preserve. The fourth point I'd like to make is that we're in the midst of an uncontrolled experiment. Now, we're not arguing against regulation at all, but what's happening is that there are a number of regulations being promulgated around the world right now that are directed at financial institutions, things like Basel III, things like derivative regulation, new talk of another round of money market fund regulations. All of these are untested, and they're all designed, oriented toward financial institutions, but frankly, they all land on the desk of the corporate treasurer. It's the financial institutions are the intermediaries. It's the consumer, it's the business person, it's the corporate treasurer that is dealing with all of these simultaneously. Senator, you raised the question of cost-benefit analysis earlier, and frankly, not only do each of these need to have a much more thorough cost-benefit analysis, but they need to be analyzed in the context of their interrelationship and what it means to simultaneously change a liquidity requirement, add a capital requirement, eliminate a trading business, and throw in a little bit of risk management or whatever you want. We have an experiment that is moving out of control. I'd like to go back to the point of capital efficiency because that is a hallmark of American business. U.S. companies are sitting on a record amount of corporate cash, and I'm sure you see those headlines, $2.2 trillion at the end of the last quarter. That represents 14% of U.S. GDP. The similar ratio in Europe is 21%. That is, European corporations hold cash on their balance sheets equal to 21% of the total GDP of the Eurozone. You might say we're 50% more efficient. Should we lose this capital efficiency and companies move to this 21% range, as a result of some regulations that aren't totally thought through, that $2.2 trillion on Americans' balance sheets at 14% 21%, that translates to $3.3 trillion. We are in effect taking $1.1 trillion out of the U.S. economy, putting it in cash on balance sheets and effectively sidelining it. So we have the potential here of destroying capital efficiency that has a magnitude that's greater than the entire stimulus program, $1.1 trillion. That's more than QE2. That's more than the entire TARP program. So, I think we're playing with fire here, and we need to be very, very careful. Hence the point on an appropriate cost-benefit analysis, not only on one regulation, but across the board. We want to make sure that America's businesses can continue to have access to the capital markets and raise capital as efficiently as possible so that they can grow their businesses, so that they can create jobs, so that they can manage their risk. And I would say, the real threshold question and what we're putting at risk here is when a business's treasurer calls a bank to raise capital or to manage risk, is there going to be a U.S. banker there to answer the call? Thank you very much.
Thank you, Mr. Carfang. I'm a little confused. I was going to ask it, go in a different place, but I want to follow up with your last statement there.
Sure.
The $2.2 trillion, the 14% of GDP that sits as cash reserves, these aren't just banks. These are, you were talking about all American companies. You're talking about Alcoa and large manufacturers that sit on large cash
I'm talking
reserves?
about all of America's non-financial corporations.
Okay.
This is published each quarter.
Yeah, I guess it seems okay. That's, and I know of that. I think we hear that often, and I guess I don't think that it's a regulatory issue as much as it's these companies don't see, for reasons of uncertainty or reasons of lack of demand, don't see it as good economics for their companies, good policy for their companies to invest back in job creation, invest in capital equipment. That's my understanding.
Well, and they also need that for working capital and precautionary needs, as you just pointed out. And my point is that the comparable number in Europe is 50% higher.
Right, I got that, the 14 versus 21. I guess when I talk to, my state, Ohio, has a large number of major manufacturers. They tell me 5 years ago that a company that might have had $100 million in cash reserves now has $400 million. I thought that's not a question of they need more in order to potentially protect themselves as much as it's they don't see the demand in the marketplace for them to reinvest in the company, or they use those dollars to buy other companies or stock pay or just stock whatever. Okay, let me go somewhere else with this, and thank you for